In the early 1970s, a man walked into his neighborhood grocery store, and while his wife stood in the checkout line, he noticed something strange happening at the register in front of them. A brand of pantyhose he'd never heard of, sold not in a department store but sitting right there next to the gum and the tabloids, was flying off the shelf. Women were grabbing multiple packages at once. The checkout clerk mentioned, almost in passing, that this particular brand had become the store's best-selling item in its entire category. Seemingly overnight, most shoppers standing in that line noticed nothing at all. They were tired, they wanted to get home, and a pantyhose display was about as unremarkable a sight as a grocery store checkout line could possibly offer. This particular man noticed everything. He went home, did some research, discovered which company made that pantyhose, bought the stock, and watched it become one of the most rewarding investments of his career. That man was Peter Lynch, and by the time he stepped down from running Fidelity's Magellan Fund in 1990, he had delivered an average annual return of roughly 29% for 13 consecutive years, a track record so extraordinary that if you had invested $10,000 with him the week he took over and simply left it alone, you would have ended up with well over $250,000 by the time he retired. He didn't do it with a supercomputer. He didn't do it with insider information. He did it by his own insistent account, using an edge available to absolutely everyone reading this right now. An edge he spent an entire book trying to convince ordinary people they already possessed and simply weren't using. That book is One Up on Wall Street, and it remains decades later one of the most practical, most quietly subversive investing books ever written. Subversive precisely because its central argument is that you, an ordinary person going about an ordinary life, are frequently in a better position to spot a great investment than the most credentialed analyst on Wall Street. That's a genuinely bold claim to make in a book about investing, and Lynch knew it. Most financial writing of his era, and honestly a great deal of financial writing since, tends to treat ordinary individual investors as amateurs who should mostly defer to the professionals, buy a broad fund, trust the experts, don't try this at home. Lynch's book remarkably argued the opposite, at least for a specific meaningful category of investment opportunity, and it backed up that argument with genuine verifiable results rather than mere motivational rhetoric. Stay with this one, because Lynch's core idea sounds almost too simple to be taken seriously at first, and that's exactly why so many people miss it. Peter Lynch took over the Magellan Fund in 1977, when it was a small, relatively obscure fund holding around $20 million in assets. By the time he stepped away, it had grown into the largest mutual fund in the world, managing many billions of dollars. And it had done so not through some exotic trading strategy, but largely through picking individual stocks, often hundreds of them at a time, an approach that itself broke from the more concentrated style favored by other legendary investors of his era. The sheer scale of that portfolio was, by most professional standards of the era, almost reckless sounding. Where many respected investors preach the virtue of deep concentration in a small handful of thoroughly researched companies, Lynch, at various points, owned well over 1,000 different stocks simultaneously. An approach some critics dismissed as impossible to genuinely research with any real depth. Lynch's own defense of this approach was characteristically practical rather than theoretical. He simply kept different types of companies to different standards, applying a lighter touch of research to smaller, more speculative positions, while reserving his deepest, most intensive homework for the handful of ideas he genuinely believed in, most strongly sized accordingly within the overall fund. It's worth being honest about a genuine practical gap between Lynch's own working life and the working life of an ordinary individual investor reading his book, one he himself acknowledged in places throughout the text. He had a large professional staff, direct access to company management, and the ability to travel constantly, visiting dozens of companies a month as his full-time job. An ordinary investor, With a demanding career of their own and only evenings and weekends available for research, obviously couldn't replicate that same scale or pace. Lynch's own advice, adjusted for this reality, wasn't that an individual investor needed to own 1,000 stocks the way he did. It was that even a modest handful of genuinely well-researched companies chosen using the same underlying discipline could meaningfully outperform a much larger, more scattered collection of shallowly understood names, meaning the ordinary investor's more limited time, rather than being a disadvantage, could actually encourage exactly the kind of focused, careful research Lynch considered essential in the first place. What made Lynch's approach genuinely different wasn't just the scale of his research. It was where a meaningful share of his best ideas actually came from. Not exclusively from spreadsheets and quarterly earnings calls, though he pored over plenty of those too, but from ordinary daily life, from his wife's shopping trips, from his daughter's opinions about a new store at the mall, from a restaurant chain that kept having a line out the door every time he happened to drive past it. His argument, laid out across the book with genuine conviction, was this: professional Wall Street analysts, however intelligent, are systemically slow to notice certain kinds of opportunities, particularly in consumer-facing businesses, retail chains, and everyday products. Precisely the categories of company an ordinary person encounters constantly in daily life, long before any analyst's spreadsheet catches up to what's already happening on the ground. An amateur investor walking through a shopping mall, noticing which stores are packed and which are empty, is gathering real, current, unfiltered market research. Lynch argued often months or years before that same information shows up in a company's quarterly earnings report, and often well before it becomes obvious enough for professional analysts, most of whom rarely set foot in an ordinary shopping mall as part of their actual working day, to notice at all. This wasn't an argument that professional investors were foolish. It was an argument that they were structurally disadvantaged in a specific exploitable way, spending their days reading spreadsheets and talking to corporate executives, rather than actually living the ordinary consumer life that reveals which products and stores people genuinely can't get enough of. He described this structural disadvantage in fairly concrete terms worth spelling out directly. A professional fund manager, however talented, typically spends the bulk of a working day in meetings on the phone with company executives who have every incentive to present their business in the most flattering possible light, or buried in spreadsheets, analyzing historical financial data that by its very nature describes the past rather than the present. That same fund manager rarely has the time, or frankly the ordinary excuse, to spend an afternoon wandering through a shopping mall or standing in a grocery store checkout line, simply observing what ordinary consumers were actually doing with their own money in real time. An ordinary individual investor, by contrast, was already doing exactly that constantly, as a simple, unavoidable part of everyday life. The only missing step was learning to actually notice it as valuable market research, rather than dismissing it as background noise unrelated to anything resembling serious investing. There's a story in the book about a company called Dunkin' Donuts that captures this idea perfectly. Lynch describes simply liking their coffee, noticing the stores were consistently busy whenever he visited, and eventually investing in the stock. The investment went on to become one of the best performers in his entire portfolio over the following years, not because Lynch possessed some secret formula, but because he paid attention to something happening right in front of him. Something millions of other coffee drinkers were also experiencing every single morning, without ever thinking to ask whether the company behind that coffee might also make for a genuinely excellent investment. He tells a similar story involving Taco Bell, describing how he first became genuinely curious about the company after eating there during a family trip, and being struck by both the quality of the food relative to its low price and the sheer efficiency of the operation itself. How quickly a line of hungry customers could be served, fed, and sent on their way. That single meal prompted him to look into the company's underlying financials, its expansion plans, and its unit economics, eventually leading to a position that performed handsomely over the years that followed. The insight didn't require any special financial training to notice in the first place. It simply required treating an ordinary lunch as a legitimate piece of market research rather than dismissing the observation the moment the meal was finished. Now, here's where a lot of casual readers of this book get the message slightly wrong, and it's worth pausing to correct that misunderstanding directly, because Lynch himself was emphatic about it throughout the book. Invest in what you know does not mean simply buying stock in your favorite restaurant or your favorite brand of sneakers purely because you personally enjoy the product. Lynch was blunt, almost impatient, about investors who took this shortcut and then blamed him when it went badly. Liking a product or noticing that a store always seems busy is only the very first step, a starting point for research, a reason to go looking further, not a substitute for actually doing that research at all. What comes next, in Lynch's method, is exactly the kind of unglamorous homework a great many casual investors skip entirely. Once you've noticed a promising company through ordinary daily life, you still need to check whether it's actually a sound business, whether its earnings are genuinely growing, whether its balance sheet carries a manageable amount of debt, whether it has room to keep expanding into new markets, and crucially, whether the stock's current price already reflects all of that promise, or whether there's still genuine room for the market to catch up to what you've noticed. Lynch laid out a fairly specific list of questions he encouraged ordinary investors to actually work through before committing real money, and it's worth walking through several of them directly, because together they form a practical checklist any patient investor could genuinely follow. What percentage of the company's total sales does the specific product or store you noticed actually represent? A wonderful new product noticed at a single location tells you far less than you might think if that particular product turns out to be a tiny sliver of a much larger, unrelated company's overall business. How much of the company's growth still lies ahead of it? Is this a business just beginning to expand into new geographic markets, or has it already saturated most of the obvious opportunity? What does the balance sheet actually look like? Is the company's expansion being funded by genuine, sustainable profits, or by an accumulating pile of debt that could become dangerous the moment growth slows even slightly? A few further questions rounded out his checklist, each addressing a different angle an enthusiastic amateur investor might otherwise overlook. Has the stock's price already run up substantially in anticipation of the very same growth story you just discovered? Meaning the easy, obvious gains may have already been captured by earlier, faster-moving investors? Who are the company's genuine competitors? And does this particular business actually have some durable advantage over them? Or is the excitement you're personally feeling likely being felt equally by customers of 2 or 3 rival companies you haven't even considered yet? And finally, is management actually reinvesting the company's profits wisely back into the business itself, continuing to fuel the very growth that first caught your attention? Or is that cash instead being diverted into exactly the kind of unrelated, diversifying acquisitions Lynch warned against so consistently throughout the rest of the book? Lynch had a memorable way of describing the discipline this required. He insisted that any investor should be able to explain, in a few simple sentences, exactly why they owned a particular stock, what the company actually did, why its prospects looked genuinely promising, and what specific developments would prove that original thesis right or wrong over time. He called this having a genuine story for every stock in your portfolio, and he was skeptical, bordering on scornful, of investors who couldn't articulate that story clearly, no matter how much money they happened to have riding on the stock. He suggested a simple, almost playful test for checking whether an investor's story genuinely held up, imagining explaining the investment out loud to a curious, moderately intelligent friend with no particular financial background. and seeing whether that explanation still sounded coherent and convincing once spoken plainly rather than dressed up in technical jargon that could sometimes disguise a genuinely shaky underlying thesis. A story that required increasingly elaborate qualifications and caveats every time it was retold, he suggested, was often quietly signaling that the original conviction behind the purchase had never been as solid as the investor initially believed, or had eroded somewhere along the way without the investor consciously noticing. If you can't explain in 2 or 3 sentences, a curious 10-year-old could follow exactly why you own a particular stock, Lynch argued. You don't actually understand your own investment well enough to know when to buy more, when to hold steady, or when to sell, and you're essentially gambling. However sophisticated the initial idea behind the purchase might have seemed, this discipline of having a clear, testable story becomes especially important once you understand how Lynch organized the entire universe of publicly traded companies, not as one undifferentiated mass of stocks, but into 6 distinct categories each, requiring a genuinely different investing strategy, a different set of questions, and a different tolerance for risk. If you're keeping track of the overall shape of Lynch's method so far, it's worth pausing to name the pattern directly, because it's easy to lose sight of amid the specific details still ahead. Everything in this book keeps circling back to a single underlying discipline approached from a dozen different angles. Notice something genuine in your own daily life. Verify that observation with real independent research. Understand exactly which type of company you're actually looking at, and then match your expectations and your patience to that specific type, rather than applying one single generic standard to every stock in your portfolio regardless of how different their underlying situations actually are. The first category Lynch called slow growers, large, mature companies, often decades old, growing their earnings only modestly, somewhere in the low single digits each year, typically paying out a healthy, reliable dividend to shareholders in exchange for that limited growth. These aren't exciting companies. They rarely make headlines, but they can play a genuinely useful, stabilizing role in a portfolio, particularly for an investor who values steady income and doesn't need explosive growth from every single holding. Lynch suggested that slow growers deserved a genuinely different set of expectations than the rest of a portfolio, and that measuring them against the same growth standards applied to a fast-expanding young company was simply a category error. The right question for a slow grower wasn't how much bigger might this become, but rather how reliably can this company sustain its current dividend, and is there any specific reason to believe that dividend, and the underlying earnings supporting it, might actually be at risk going forward. A slow grower that reliably raised its dividend year after year, even by a modest amount, represented a fundamentally different and often perfectly reasonable kind of investment than a fast grower, simply one an investor needed to evaluate on its own appropriate terms. The second category, stalwarts, sits a step up in ambition, large, well-established companies growing their earnings at a moderate pace, typically somewhere in the range of 10 to 12% annually. Lynch considered these solid, dependable holdings, capable of doubling in value every several years under favorable conditions, but unlikely to deliver the truly spectacular returns that made his career genuinely legendary. He suggested treating stalwarts almost like a defensive core for a portfolio. Companies an investor could hold through an economic downturn with reasonable confidence. They'd weather the storm intact, even if they weren't going to generate the most exciting returns during the good years. He offered a specific practical rule of thumb for managing stalwart positions that's worth remembering directly. Because these companies were already large and well-established, their growth naturally tended to slow further as they matured, meaning an investor holding a stalwart shouldn't expect to hold it forever with the same patient conviction appropriate for a genuinely young, fast-growing company. Once a stalwart's price had appreciated substantially relative to its earnings, without any corresponding acceleration in its actual growth rate, Lynch suggested it was often reasonable to trim the position and look elsewhere for the next opportunity, rather than holding on indefinitely purely out of habit or sentimental attachment to a name that had served the portfolio well in the past. The third category is where Lynch's own personal enthusiasm and the bulk of his most celebrated successes genuinely lived. Fast growers, smaller, aggressive, often relatively young companies expanding their earnings at 20% a year or considerably more frequently by taking a successful proven business model and rapidly replicating it across new markets and new locations. This is where Lynch introduced one of the book's most memorable concepts, the ten-bagger, his own colorful term for a stock that increases in value tenfold from the price at which you originally bought it. He argued that finding even one or two genuine ten-baggers and having the patience and conviction to actually hold on to them through their entire growth trajectory rather than selling too early out of nervousness could meaningfully transform an entire investment portfolio's long-term performance, even if the rest of that portfolio's holdings only performed modestly. He was refreshingly candid about how difficult it was, even for him, to actually recognize a ten-bagger while it was still early in its growth story, rather than only in comfortable hindsight once the outcome was already obvious to everyone. Most of his own eventual ten-baggers, he admitted, didn't look like obviously spectacular opportunities at the moment he first bought them. They looked like ordinary, reasonably promising small companies, one holding among hundreds in a sprawling portfolio that simply kept executing well, quarter after quarter, year after year, gradually compounding into something extraordinary only in retrospect. This meant an investor genuinely hoping to catch a ten-bagger needed to resist the temptation to sell a winning fast grower purely because it had already doubled or tripled, since that early success was often merely the first several chapters of a much longer growth story still unfolding. He described a specific psychological trap that repeatedly cost investors their own ten-baggers before those stocks ever had the chance to fully mature, selling a stock that had already doubled purely to lock in a comfortable, satisfying gain, out of an understandable but ultimately costly instinct to avoid the discomfort of watching a paper profit potentially shrink again. Lynch pointed out that this instinct, however psychologically understandable, directly contradicted the entire premise of his own most celebrated successes, since almost none of his own ten-baggers arrived in a single smooth, uninterrupted climb. Nearly every one of them experienced multiple meaningful pullbacks and periods of stagnation along the way, testing the patience of any shareholder holding on before eventually resuming their climb toward that full tenfold return. An investor who sold at the first comfortable double purely to avoid that intervening discomfort would have missed the majority of the eventual gain entirely. Fast growers, Lynch cautioned, also carried genuinely elevated risk precisely because of that same aggressive growth. A company expanding rapidly, opening new locations or launching new products at a breakneck pace can just as easily stumble badly if that expansion outpaces the company's own management capacity, its available capital, or the genuine underlying demand for whatever it's selling. The same aggressive growth that produces a ten-bagger, taken slightly too far or executed slightly too carelessly, can just as easily produce a company that collapses under the weight of its own overexpansion. He suggested one particularly useful concrete way to monitor a fast grower's health over time, tracking a retail chain's same-store sales figures, meaning the sales growth generated purely from existing locations, separate from the additional sales simply generated by opening brand new stores. A company that kept opening new locations while its existing established stores quietly began losing momentum was showing an early warning sign worth taking seriously, even while the company's total headline sales figure continued climbing impressively thanks purely to the ongoing expansion. Same-store sales, Lynch argued, told you far more honestly whether the underlying business model itself was actually still working, independent of the temporary boost provided by opening additional new locations. He described this specific metric as one of the clearest early warning signs available to an ordinary investor willing to actually dig a level deeper than the headline sales figure most casual observers stopped at. A retail chain could, for a surprisingly long stretch of time, mask a genuinely weakening core business simply by continuing to open new stores fast enough that the additional revenue from those new locations more than offset the quiet decline happening at its older, established stores. By the time that masking effect finally ran its course, once the pace of new store openings inevitably had to slow, whether due to market saturation or simple capital constraints, the underlying weakness in the existing store base would suddenly become fully visible in the company's overall results, often catching investors who had only ever glanced at the flattering headline sales number genuinely by surprise. The fourth category, cyclicals, covers companies whose fortunes rise and fall in a fairly predictable rhythm tied to the broader economy. Automakers, airlines, steel manufacturers, chemical producers, and similar businesses whose sales swell during economic booms and shrink noticeably during recessions. Lynch devoted real attention to a genuinely counterintuitive insight about cyclical stocks that trips up a great many otherwise sensible investors. Timing matters enormously, more here than in almost any other category, and the obvious surface-level signals can actively mislead you if you're not paying close enough attention to where a particular industry actually sits in its own cycle. A cyclical stock trading at what looks like an impressively low price-to-earnings ratio, Lynch warned, is very often not a bargain at all. It's frequently a warning sign that the company's profits are currently near a cyclical peak, about to decline sharply as the broader economic cycle inevitably turns, meaning that seemingly cheap price is actually about to look considerably less cheap once next year's earnings come in far lower. Conversely, a cyclical stock trading at what looks like an alarmingly high price-to-earnings ratio might actually represent the more genuine opportunity, a sign that the company's earnings have already bottomed out near a cyclical trough and are poised for a substantial recovery as conditions improve, which would make that currently high ratio look considerably more reasonable within a year or two. He illustrated this with the example of automakers, an industry whose fortunes have historically swung dramatically between boom and bust alongside the broader economy. During a strong economic expansion, with consumers flush with confidence and readily available credit, automakers can post genuinely enormous profits, pushing their price-to-earnings ratio down to what looks, on the surface, like an unmissable bargain. Lynch's own experience taught him to treat that apparent bargain with real suspicion rather than excitement, because those boom-time profits were, almost by the nature of the industry, unlikely to persist once the broader economy inevitably cooled and car buyers pulled back. The investor who bought purely because the ratio looked cheap, without understanding where the automotive cycle genuinely stood, risked buying at almost precisely the wrong moment just before earnings collapsed and dragged the stock price down along with them. He described a nearly identical dynamic playing out in the airline industry, another classically cyclical business whose profitability rises and falls sharply alongside broader economic conditions, fuel costs, and consumer willingness to travel. An airline reporting record profits during a booming economy, with planes flying consistently full and fares holding firm, would often trade at a deceptively low price-to-earnings ratio precisely at the moment its earnings were least likely to be sustained. Lynch encouraged investors interested in cyclical industries like this one to pay far closer attention to where a specific company sat within its broader industry cycle, tracking capacity, fuel prices, and consumer travel demand directly, than to the headline valuation ratio alone, which, taken in isolation, could mislead an unwary investor into buying at almost precisely the wrong moment in the cycle. This runs directly counter to the instinct most investors bring to reading a price-to-earnings ratio for any ordinary non-cyclical company, and Lynch considered this exact confusion one of the most common, costliest mistakes made by investors dabbling in cyclical industries without fully understanding this particular quirk. The fifth category, turnarounds, covers companies that have fallen on genuinely hard times, perhaps facing bankruptcy, a major scandal, a failed product line, or some other serious crisis, but that possess a plausible, credible path back toward health. Lynch was drawn to these situations specifically because they tend to be deeply unpopular among mainstream investors and largely ignored by Wall Street analysts precisely when the company's fortunes are in fact quietly beginning to improve, creating exactly the kind of overlooked opportunity his entire method was designed to hunt for. He broke turnarounds down further into several distinct subtypes worth distinguishing carefully because they carry meaningfully different risk profiles. Some companies face a genuine bet, the company crisis, where survival itself is genuinely uncertain, and the potential reward for correctly picking a survivor is matched by the very real possibility of losing the entire investment if the company fails instead. Others face a more contained, less existential problem, a single struggling division dragging down an otherwise healthy company, where simply selling or fixing that one problematic unit could unlock considerably more value than the market currently seems to recognize. There's a third distinct subtype worth naming directly. Companies facing what Lynch described as a hidden asset problem masquerading as a genuine crisis where a temporary fixable issue, perhaps a lawsuit, a product recall, or a bad quarter, tied to some clearly identifiable non-recurring cause, has frightened away casual investors far more severely than the underlying facts actually warranted. The genuine skill in evaluating any turnaround, Lynch insisted, lay in correctly distinguishing which of these subtypes a given struggling company actually represented, because a company facing a genuinely existential survival-threatening crisis required an entirely different level of caution and position sizing than a fundamentally sound company merely working through a single containable temporary problem. He also emphasized watching a struggling company's balance sheet with particular care in any turnaround situation. Since a company with manageable debt levels had considerably more room and time to actually execute a genuine recovery than a company already drowning in debt obligations it could barely service even before the crisis began. A promising turnaround story attached to a genuinely over-leveraged balance sheet, in his experience, was a meaningfully riskier bet than the same turnaround story attached to a company with a more conservative capital structure. Regardless of how compelling the recovery narrative itself otherwise sounded, he described a specific, practical way an ordinary investor could gauge this risk without needing an advanced accounting background, checking how a struggling company's total debt compared to its available cash and to the value of assets it could realistically sell if needed, and separately checking whether its lenders had already granted any waivers or renegotiated terms, a signal that the company's own creditors were themselves nervous about the near-term outlook, a turnaround candidate that still had genuine breathing room on its debt obligation. Giving management enough time to actually execute a multi-year recovery plan without the constant threat of an imminent default represented a meaningfully different, more attractive risk profile than one where the balance sheet itself created a ticking clock that could force a bankruptcy long before any operational recovery had the chance to take hold. The sixth and final category, asset plays, covers companies sitting on some valuable asset that the broader market has, for whatever reason, significantly underappreciated. Perhaps real estate carried on the books at a decades-old purchase price, far below its genuine current market value. Perhaps a large cash reserve. perhaps a valuable subsidiary or patent portfolio that isn't being properly reflected in the company's overall stock price. Lynch found these situations particularly appealing precisely because they often required local or specialized knowledge that an ordinary Wall Street analyst working from a distance might genuinely lack knowledge. An investor with direct personal or professional familiarity with a specific region, industry, or type of asset might actually possess themselves. He told a story about a company holding valuable timberland, purchased decades earlier at prices that had become almost comically low by the time he was evaluating the stock, where the sheer value of that underlying land, largely ignored by mainstream financial analysis, focused purely on quarterly earnings, represented a substantial hidden cushion beneath the company's stock price, a cushion invisible to anyone who hadn't specifically thought to go looking for it. He offered a second, distinct kind of asset, play worth mentioning separately. Companies carrying substantial tax loss carry-forwards on their books accumulated during an earlier period of financial difficulty, which could be used to meaningfully offset future taxable profits once the underlying business finally returned to genuine profitability. This kind of hidden asset was, in a sense, doubly overlooked, since it required an investor to both recognize that a struggling company's underlying business was genuinely on the mend, and separately understand the specific tax mechanics that would make its eventual recovery meaningfully more profitable after taxes than a casual read of the company's recent loss-making financial history would suggest to anyone glancing only at the headline numbers. A third, somewhat simpler kind of asset, play worth naming, directly involved companies simply sitting on an unusually large cash reserve relative to their overall stock market value, cash accumulated over years of profitable operations that management, for whatever reason, hadn't yet deployed into new investments, acquisitions, or shareholder returns. Lynch encouraged investors to check specifically how much of a company's total market value was represented purely by cash sitting on its balance sheet. Since a company trading at a price only modestly above its own cash holdings was in effect being valued by the market as though its actual operating business were worth very little at all, a situation that, once recognized and properly researched, occasionally represented a genuinely mispriced opportunity, particularly if that operating business, examined honestly on its own separate merits, actually had real underappreciated value of its own. Understanding which of these 6 categories a company genuinely belongs to, Lynch insisted, was one of the single most important steps in the entire research process, because it fundamentally changes what an investor should actually be looking for and what would legitimately justify buying or selling the stock. Applying the standards appropriate for a fast grower to a slow-growing, mature utility company, or applying the standards appropriate for a stable stalwart to a genuinely risky turnaround situation was, in Lynch's view, one of the most common and avoidable mistakes an otherwise careful investor could make. Lynch extended his core argument about everyday observation into a related, slightly more specific idea worth mentioning directly, that an investor's own professional expertise, whatever field they happen to work in, often represented an even sharper edge than ordinary consumer observation alone. A nurse or a hospital administrator, he pointed out, might notice a genuinely superior new medical device or pharmaceutical product being adopted enthusiastically by colleagues months or years before that adoption showed up clearly in the manufacturer's published financial results. A retail employee might notice which supplier's products consistently sold out fastest, or which brands kept getting reordered most urgently, long before that same pattern became visible in any public sales report. An engineer might recognize which of several competing industrial suppliers actually made the more reliable, better engineered component, an insight considerably harder for an outside financial analyst lacking that same technical background to independently verify. He offered one further example worth remembering involving an accountant who happened to notice, purely through the ordinary course of preparing tax returns for several small business clients in the same specific industry. Which particular supplier's invoices kept appearing across nearly every client's books, a pattern suggesting an unusually dominant, entrenched market position that wouldn't have been nearly as obvious to anyone without that same specific repeated professional exposure. The lesson Lynch drew from stories like this one was consistent throughout the book. Genuine investment insight rarely required inventing some elaborate new research process from scratch. It far more often simply required noticing and taking seriously the specialized knowledge a person had already quietly accumulated through the ordinary, unglamorous business of doing their own job well. This meant that the single most valuable edge available to any individual investor, in Lynch's view, wasn't necessarily found by searching randomly through unfamiliar industries, hoping to stumble across an interesting story. It was often sitting closer to home than most people ever thought to look, inside their own workplace, their own professional training, their own daily unglamorous routine, which had already given them a genuine head start of specialized knowledge that even a talented Wall Street analyst working from the outside simply couldn't easily replicate. It's worth acknowledging honestly, too, a fair criticism sometimes raised about this entire approach, one worth sitting with directly rather than glossing over. Lynch's own most celebrated successes, the stories he tells throughout the book, were naturally selected because they worked out extraordinarily well. And it's worth remembering that for every triumphant story like the pantyhose discovery or the Dunkin' Donuts investment, there were inevitably other ordinary consumer observations, made with equal enthusiasm and equal confidence at the time, that simply never turned into anything special at all, and that the book, understandably, spends far less time recounting. Noticing a busy store or a popular product is a genuinely useful starting point for research, exactly as Lynch always insisted. It is not on its own any guarantee of a good outcome, and an investor applying this method seriously should expect a great many ordinary, unremarkable observations for every one that eventually pays off the way the book's most memorable stories did. Once you've identified a promising company, ideally through some genuine first-hand observation from daily life, and once you've placed it correctly into one of these 6 categories, Lynch's book turns toward what might be its single most practical, most immediately actionable contribution, a checklist of qualities that together describe what he only half-jokingly called the perfect stock. The first quality on his list sounds almost like a joke, and Lynch clearly enjoyed presenting it that way, but he meant it with genuine seriousness: a boring, or even mildly ridiculous-sounding company name. His reasoning was refreshingly practical rather than superstitious. A company with a genuinely dull or unglamorous name is far less likely to attract the kind of speculative attention and inflated valuation that a flashy, exciting-sounding name tends to generate among casual investors chasing whatever sounds most impressive at a cocktail party, leaving more genuine room for an attentive, patient investor to buy in before the broader crowd catches on. He even joked that if he could design the perfect company purely to remain undiscovered by casual investors for as long as possible, he'd deliberately give it the most forgettable, unremarkable name imaginable. The second quality, closely related, is a genuinely boring or even actively unpleasant underlying business. Companies making, say, bottle caps, industrial waste disposal equipment, or funeral services, rather than anything glamorous enough to generate excited magazine cover stories. Lynch found that unglamorous, unsexy businesses were consistently overlooked by professional analysts more interested in covering exciting, headline-grabbing industries, leaving genuine value sitting unnoticed simply because nobody particularly enjoyed researching or writing about it. A company manufacturing an unglamorous industrial component that every factory in a given industry genuinely needed could quietly generate excellent, reliable profits for decades, entirely below the notice of financial journalists who understandably preferred writing about more exciting subjects. The third quality is a business that people find genuinely distasteful or off-putting to even discuss, something in an industry like waste management, debt collection, or funeral services, where the social awkwardness of the subject matter itself tends to keep casual investors and financial journalists at arm's length, leaving the field more open for anyone willing to look past the discomfort and evaluate the underlying business on its actual merits. Lynch pointed out, with characteristic dry humor, that a genuinely essential service nobody enjoys discussing at a dinner party often continues generating steady demand, precisely because the underlying need never truly disappears, regardless of how uncomfortable the topic makes casual conversation. The fourth quality is a corporate spin-off, a company that has recently been split off from a larger parent corporation. Lynch found these situations particularly promising because large institutional shareholders who had originally received shares in the spin-off simply as an automatic byproduct of owning the parent company's stock would very often sell those new shares immediately and indiscriminately, regardless of the spin-off's actual underlying quality, purely because the new, smaller company didn't fit their existing investment mandate or wasn't yet large enough to meet their minimum size requirements. That indiscriminate forced selling could temporarily push a genuinely excellent company's stock price well below what its actual underlying fundamentals deserved, creating a real opportunity for a patient individual investor willing to do the homework the institutions themselves hadn't bothered doing. He noted that spin-offs also frequently benefited from a specific structural advantage worth understanding directly, freed from a large parent corporation's bureaucracy and sometimes from a parent's tendency to starve a smaller division of the capital and management attention it genuinely needed to thrive. A newly independent spin-off could often accelerate its own growth considerably once it was finally able to make its own capital allocation and strategic decisions unencumbered by a larger corporate structure that may have treated it as a secondary priority for years. An investor watching for spin-offs, specifically checking each new one against the rest of Lynch's checklist, could find genuine opportunities precisely in that awkward, overlooked window immediately following the separation, before the broader market had caught up to the newly independent company's improved prospects. He suggested a practical habit worth adopting for exactly this reason: actually reading the announcements whenever a company an investor already followed decided to spin off a division, rather than simply ignoring the new smaller entity as an unwanted afterthought the moment the shares landed in a brokerage account. The management team newly running that spin-off, freshly motivated by their own independent stock options and a genuine opportunity to prove themselves outside their former parent's shadow, often brought a renewed sense of urgency and focus that a casual observer dismissing the spin-off purely because it was small and unfamiliar would otherwise miss entirely. The fifth quality is genuine insider buying, company executives and directors using their own personal money to purchase additional shares of their own company's stock on the open market. Lynch considered this one of the most reliable, honest signals available to an outside investor, precisely because executives have such intimate, detailed knowledge of their own company's genuine prospects. Executives sell their company's stock for all sorts of ordinary personal reasons, entirely unrelated to their view of the business: diversifying their savings, paying for a home, funding a child's education. But they very rarely spend their own money buying additional shares unless they genuinely believe the stock is undervalued relative to where the business is actually headed. He suggested a specific way of weighing this signal that added genuine nuance beyond simply noting that some insider buying had occurred at all, paying particular attention to whether multiple different executives and directors, rather than just one, were buying around the same time, and whether the purchases represented a genuinely meaningful sum relative to each individual's own personal wealth, rather than a token symbolic amount purchased mainly for appearances. A single executive buying a small, almost negligible number of shares told an investor considerably less than several senior executives independently making substantial personal purchases within the same several-month window, a pattern that suggested a genuine, broadly shared conviction within the company's own leadership rather than one individual's isolated opinion. He also drew a useful distinction between insider buying that occurred quietly, without any accompanying fanfare, and insider buying that came wrapped in an aggressive public relations push. Since executives occasionally bought a small number of shares purely as a symbolic publicized gesture, meant to reassure nervous shareholders during a difficult period, without genuinely reflecting the kind of deep personal conviction a large, unpublicized purchase tended to represent. The purchases most worth an outside investor's attention in his experience were the quieter ones, filed as required by regulation, but not accompanied by any deliberate effort to draw public attention to them, since those tended to reflect an executive's genuine personal belief rather than a calculated attempt to manage outside perception. The sixth quality is a company actively engaged in buying back its own shares from the open market. When a company repurchases its own stock, it reduces the total number of shares outstanding, meaning each remaining share represents a slightly larger ownership stake in the underlying business and its future profits. Lynch viewed a genuine, sustained buyback program funded by real earnings rather than by taking on excessive new debt as a meaningful vote of confidence from the people who understood the company's prospects better than almost anyone else, its own management. He drew an important distinction here worth remembering between a genuine, disciplined buyback program and a company simply announcing a large buyback purely for its public relations value, without actually following through with sustained purchases over time. Lynch encouraged investors to check a company's actual share count over several consecutive years, rather than simply taking a single splashy buyback announcement at face value, since the real, measurable test of a genuine buyback program was a steadily shrinking total share count sustained across multiple years, not a single headline-grabbing announcement that may or may not have been fully carried out in practice. The seventh quality Lynch looked for was low or minimal institutional ownership, meaning the stock wasn't yet heavily owned by large mutual funds, pension funds, and other major institutional investors. This mattered for a simple, structural reason. Once a stock becomes widely owned by large institutions, a significant share of its available upside has often already been captured, and any bad news tends to trigger disproportionately severe selling as multiple large institutional holders rush toward the exit simultaneously. A stock still largely overlooked by institutional money, by contrast, still had genuine room to attract that larger pool of capital in the future, providing a potential source of continued price appreciation as bigger investors gradually discovered the story. Lynch pointed out a related, somewhat ironic dynamic worth understanding here. A company genuinely could be too small or too obscure for many large institutional funds to buy meaningfully, even if they wanted to, simply because purchasing a large enough position to matter for a multi-billion-dollar fund would itself distort the stock's price or exceed the fund's own internal rules about maximum ownership stakes in smaller companies. This created a persistent structural inefficiency an individual investor, unconstrained by those same institutional size requirements, could take genuine advantage of, buying meaningfully into a smaller promising company years before it grew large enough to attract the wave of institutional buying that would eventually help push its price up further. He added a further practical observation about how this dynamic tends to resolve itself over time, worth remembering as a kind of built-in tailwind for exactly the type of overlooked company his checklist was designed to identify. As a genuinely excellent smaller company kept growing its earnings and its overall market value, it would at some point cross various size thresholds that made it newly eligible for a wider range of institutional funds to purchase, sometimes triggering a fresh wave of buying interest from funds that had simply been waiting for the company to become large enough to fit within their own mandates. An individual investor who had gotten in years earlier, well before that institutional eligibility threshold was crossed, stood to benefit directly from that later wave of new buying interest, entirely independent of any further improvement in the underlying business itself. Closely related. The eighth quality was minimal analyst coverage. Few or no Wall Street research reports actively following and recommending the stock. Lynch reasoned that a company nobody on Wall Street was talking about yet was almost by definition a company where genuine informational advantages were still available to an attentive individual investor willing to do independent homework rather than simply reading a report that had already been read and acted on by every other institutional investor in the country. He offered a simple, practical way an ordinary investor could check this for themselves, requiring no special access at all, simply calling the company's investor relations department directly and asking how many professional analysts currently cover the stock. A company that a receptionist could answer in a single breath, naming one or two analysts total, or perhaps none at all, represented exactly the kind of overlooked opportunity Lynch spent his career hunting for. A company followed by dozens of analysts, by contrast, had likely already had most of its available informational edge thoroughly picked over by the time an ordinary individual investor got around to looking at it. The ninth quality involved companies surrounded by unpleasant, off-putting rumors, genuine concerns about legal liability, environmental contamination, or some other serious-sounding controversy that scared away the overwhelming majority of casual investors, even in cases where the actual financial exposure to the company, once carefully researched, turned out to be considerably smaller than the frightening headlines suggested. Lynch found that these situations, approached carefully and skeptically rather than recklessly, occasionally offered genuine opportunities precisely because the scary headline had done more damage to the stock price than the underlying financial reality actually justified. He was careful to add a genuine word of caution alongside this particular quality, since it's easily the riskiest item on his entire list to apply carelessly. Not every scary headline turns out to be overblown, and some genuinely do presage real, lasting financial damage to the underlying company. The discipline required here wasn't blind contrarianism, buying purely because a stock had become unpopular. It was doing the actual homework needed to determine, with real evidence rather than hopeful assumption, whether a specific frightening headline represented a genuinely temporary containable problem or a legitimate, lasting threat to the company's underlying business. He described a specific category of frightening headline that in his experience tended to prove more containable than the initial panic suggested, a company facing a lawsuit or regulatory concern tied to a single identifiable product line or business unit, where the company's overall financial strength meant it could realistically absorb whatever settlement or fine eventually resulted without threatening the survival of the business as a whole. He contrasted this with a genuinely more dangerous category, an existential legal or regulatory threat tied to the company's entire core business model, where no reasonable settlement or fine could resolve the underlying problem, since the very thing generating the company's revenue was itself the source of the controversy. Distinguishing between these two categories, rather than treating every scary headline identically, was precisely the kind of careful case-by-case judgment this particular quality demanded. The 10th quality Lynch looked for was a company operating in a genuinely unglamorous, no-growth industry, not because stagnant industries were inherently attractive, but because a genuinely excellent, well-managed company operating within an unexciting industry faced dramatically less competitive pressure from ambitious new entrants than it would if it were operating in an obviously exciting, rapidly growing field that every well-funded startup and established competitor was simultaneously racing to enter. A modest, Boring industry with limited growth prospects overall still leaves plenty of room for a single genuinely excellent company within that industry to steadily take market share from its less capable competitors year after year without ever having to fend off a constant parade of eager new challengers. He put this observation somewhat provocatively, noting that a genuinely exciting, rapidly growing industry was almost paradoxically one of the more difficult environments in which to find a truly excellent individual stock, precisely because that excitement attracted enormous amounts of competing capital and ambitious new entrants, all racing for the same growing pool of customers, frequently at each other's expense, through aggressive margin-destroying price competition. A genuinely dull, slow-growing industry, by contrast, tended to attract far less competitive attention, allowing a single well-run company within it to quietly and steadily dominate its modest corner of the market for decades, without ever needing to fend off a constant parade of eager new challengers drawn purely by the industry's own excitement. He described watching this play out repeatedly with genuinely exciting technology sectors throughout his career. A wave of enthusiasm draws in dozens of well-funded competitors simultaneously, each convinced their own version of the product will win. And the resulting price war and marketing spending arms race often left even the eventual long-term winner with years of thin, disappointing profit margins before any clear dominance finally emerged, if it ever did at all. Compare that to an unglamorous, slow-growing industry like, say, a specific type of industrial cleaning service or a narrow category of commercial insurance where the total addressable market simply wasn't exciting enough to draw that same competitive intensity, leaving a single well-managed incumbent free to quietly compound its earnings and its market share for years, entirely undisturbed by the kind of aggressive new entrants that plagued its more fashionable counterparts. The 11th quality was a genuine market niche, some kind of durable competitive protection, whether through a specialized product, an entrenched local market position, or some other structural advantage that made it meaningfully difficult for a larger, better-funded competitor to simply muscle in and take away the company's market share. He offered a specific test for evaluating whether a niche genuinely qualified as durable rather than merely convenient for the moment, asking what would actually stop a large, well-funded competitor from entering this exact same market next year and undercutting the company on price. A niche defended purely by modest brand recognition or a temporary lack of competitor interest, Lynch warned was considerably more fragile than a niche defended by something structurally harder to replicate, specialized manufacturing expertise built up over decades, exclusive long-term contracts with key suppliers or customers, or a genuinely superior product protected by real patents, rather than merely a head start that any well-capitalized rival could eventually close. He described a favorite example of this kind of durable niche, a small company holding a near monopoly on a highly specialized industrial process that larger competitors had little genuine incentive to enter. Since the total addressable market was modest enough that a larger company's investment simply wouldn't move the needle on its own overall results, even while that same modest market represented an entirely meaningful, genuinely profitable business for the smaller specialist already entrenched there. Size. In this particular sense, cut in the smaller company's favor rather than against it, the niche was, in effect, protected by its own limited scale, since it simply wasn't attractive enough to draw serious competitive attention from the giants who could otherwise have crushed it easily. He offered a second illustration of this same principle worth mentioning, involving a company providing a highly specialized service to a narrow, specific customer base within a single industry where deep, accumulated familiarity with that customer base's particular needs and regulatory requirements represented a genuine barrier to entry that no amount of general business competence alone could easily replicate. A large, well-funded competitor entering that market would need years to build the same specific relationships and specialized knowledge the existing niche player had already accumulated, giving the incumbent a genuine, durable head start that a competitor's raw size and resources couldn't simply purchase or shortcut around. And the 12th quality, perhaps the simplest and most relatable of the entire list, was a product that people needed to buy repeatedly, again and again, rather than only once. The difference between a company selling something people purchase every week without much thought, and a company selling something people purchase only rarely requiring far more sustained effort to keep growing sales year after year. Lynch pointed to the simple, almost obvious appeal of consumable repeat purchase products as one of the most reliable engines of steady, predictable revenue a company could possibly have. A product people bought once and rarely needed again required a company to constantly find brand new customers just to sustain its existing revenue, a genuinely difficult, expensive, ongoing task. A product people bought again and again, almost habitually, meant a company's existing customer base itself became a genuinely valuable, self-renewing asset, generating dependable revenue quarter after quarter without requiring the same constant, expensive hunt for entirely new buyers. He contrasted this directly with businesses selling large, infrequent purchases. A company selling, say, industrial machinery replaced only once every decade faced a fundamentally different, more difficult growth challenge than a company selling a household staple, replenished every single week. Since the machinery company's growth depended almost entirely on finding brand new customers or waiting patiently for its existing customers' equipment to eventually wear out, while the household staple company enjoyed the considerable advantage of its own installed base of loyal, repeat customers steadily generating revenue with minimal additional selling effort required quarter after quarter, almost regardless of how the broader economy happened to be performing at any given moment. Lynch was careful to note that very few real companies would ever satisfy every single item on this admittedly demanding list simultaneously. And that wasn't really the point of laying it out at all. The list existed to sharpen an investor's instincts, training them to notice and appreciate exactly the kinds of overlooked, unglamorous qualities that a more conventional headline-chasing approach to investing would typically walk right past without a second glance. Just as important as what Lynch looked for in a genuinely promising company was what he warned investors to actively avoid, and one particular warning delivered with real pointed frustration throughout the book deserves special attention, a phenomenon he gave a memorably blunt name to, calling it diversification. This described a specific recurring mistake he watched large, otherwise successful companies make repeatedly throughout his career, taking the substantial profits generated by their core, genuinely excellent business and using that cash to acquire other, entirely unrelated companies in industries the original management team had no particular expertise in at all, purely for the sake of diversifying the parent corporation's overall revenue base. Rather than actually reducing risk, as the term diversification might suggest, these ill-considered acquisitions frequently ended up destroying real shareholder value, saddling an otherwise excellent core business with a poorly understood, poorly managed collection of unrelated side ventures that management struggled to run effectively. Precisely because their genuine expertise and competitive advantage had never extended into those newly acquired businesses in the first place. He described a recurring pattern he'd watched play out at company after company, almost like a predictable script. A wonderfully successful core business generates enormous, reliable cash flow. Management, flush with that cash, and perhaps growing a little restless or overconfident after years of success in their original field, decides the company needs to diversify beyond its current, seemingly limited growth ceiling. They acquire an unrelated business, often paying a substantial premium to do so, justifying the purchase with confident talk of synergies and diversified revenue streams. Years later, that acquired business turns out to require far more management attention and capital than originally anticipated, distracting leadership from the genuinely excellent core business that made the whole company successful in the first place. And the acquired division is eventually sold off, often at a considerable loss, in a belated attempt to refocus on the original, proven strength that never should have been diluted in the first place. Lynch encouraged investors to watch carefully whenever a company they owned announced a major acquisition entirely outside its core area of demonstrated expertise, treating it as a genuine yellow flag, worth investigating rather than automatically assuming bigger and more diversified necessarily meant safer or more valuable. A company that stuck disciplined and focused within an area it genuinely understood deeply, investing its profits into expanding that core business further, rather than chasing unrelated new ventures, was in his experience far more likely to keep compounding shareholder value reliably over the long run. He offered a specific, practical test worth applying whenever a company announced a major acquisition, asking whether the stated strategic rationale genuinely made sense on its own terms, or whether it relied heavily on vague buzzword-heavy language about synergies and diversification that, on closer inspection, didn't actually explain how the specific combination of these two particular businesses would create genuine value beyond what each company could achieve entirely on its own. Acquisitions genuinely worth cheering, in his experience, tended to have simple, concrete, easily explainable rationales. Expanding into an adjacent market the company already understood well, or acquiring a supplier or distributor that meaningfully improved the core business's own existing operation. Acquisitions that required an elaborate explanation full of abstract corporate jargon to justify, he suggested, often turned out to be exactly the kind of diversifying mistake that would cost shareholders dearly within a few years. He suggested a further, simple sanity check worth applying whenever a company announced a large acquisition, comparing the price actually being paid to the acquired company's own recent earnings and growth trajectory. Exactly the same disciplined analysis Lynch insisted on applying to any ordinary individual stock purchase, a company overpaying substantially for an acquisition relative to what that acquired business's own underlying fundamentals reasonably justified, was effectively destroying value on behalf of its existing shareholders the moment the deal closed, regardless of how strategically sound the broader rationale sounded in the press release announcing it. Lynch treated a large acquisition, in other words, exactly like any other individual stock purchase deserving of the same rigorous scrutiny, a discipline that, in his experience, a great many otherwise careful corporate management teams somehow abandoned entirely the moment they were spending the company's money rather than their own. He offered a related warning about the seductive pull of investing in whatever industry happened to be generating the most excitement and media attention at any given moment. The hot new technology, the trendy new retail concept, the industry everyone at a dinner party seemed to be talking about with breathless enthusiasm. By the time an industry has become genuinely fashionable enough to dominate casual conversation this way, Lynch argued, a great deal of institutional money has usually already piled in, bidding up valuations across the entire sector, often well beyond what the underlying businesses could realistically justify, leaving considerably less room for a late-arriving individual investor to capture the kind of outsized returns available earlier before the crowd noticed. He described watching this pattern repeat itself across multiple different hot industries throughout his own career, each one following a remarkably similar arc. A genuinely promising new technology or business concept emerges. A handful of early companies within that space perform spectacularly well, attracting enormous media attention and a flood of eager new investors, A wave of new companies rushes in to compete for the same suddenly fashionable opportunity, driving valuations across the entire sector to levels that would require years of flawless execution just to justify. Competition intensifies. Profit margins get squeezed as too many companies chase the same customers, and a great many of the newer, less capable entrants eventually fail entirely, taking a substantial share of investors' capital down with them. The genuinely excellent original companies within that space, Lynch noted, sometimes did go on to reward patient long-term shareholders, but the crowd of newer investors arriving late, chasing the sector's fashionable reputation rather than any specific, individually researched company, very often ended up losing money, even while the broader industry itself continued growing exactly as originally predicted. He suggested a simple test worth applying whenever a particular industry started dominating headlines and casual conversation this way, asking not whether the underlying technology or trend was genuinely real and important, since it very often was, but whether the specific company being considered had actually been researched on its own individual merits, using the same 15-point style scrutiny applied to any other stock, rather than being purchased purely as a way of participating in the broader excitement surrounding the sector as a whole. He was equally skeptical of stock tips arriving second-hand from friends, neighbors, or casual acquaintances, what he sometimes referred to, with a certain dry humor, as advice picked up at a cocktail party or from a chatty hairdresser. Not because such tips were necessarily always wrong, but because accepting a stock recommendation from someone else without doing your own independent homework to understand the underlying business left you without the genuine conviction and understanding needed to hold steady through an inevitable rough patch, or to recognize promptly when the original thesis had genuinely broken down and it was time to sell. He described a memorable, slightly self-deprecating rule of thumb he applied to his own social life, treating any stock tip offered enthusiastically at a party, especially one accompanied by a confident promise that the stock was certain to double, with immediate healthy skepticism rather than excitement. His reasoning wasn't that party guests were necessarily dishonest or foolish. It was simply that a stock genuinely worth buying deserved the same careful, independent research, regardless of who first mentioned it, and that the social pressure and excitement of a live conversation made it considerably harder to apply that same sober scrutiny in the moment than it would be sitting alone later, with the company's actual financial statements spread out in front of you. This connects directly back to Lynch's insistence on having a clear, testable story for every single holding in your portfolio. An investor who bought a stock purely because a friend mentioned it sounded promising has no real story of their own to fall back on the moment the stock drops sharply on some piece of bad news. An investor who did the actual homework, who genuinely understands why they own a particular company and what specific developments would prove that original thesis right or wrong, is far better equipped to distinguish a genuine thesis-breaking problem from ordinary short-term market noise that shouldn't change anything at all. Lynch also devoted real practical attention to a specific analytical tool that helps translate his qualitative instincts into something more concretely measurable, comparing a stock's price-to-earnings ratio against its actual underlying earnings growth rate. A relationship sometimes described using a ratio called the PEG ratio. The basic idea is straightforward enough to explain simply. A stock trading at a price-to-earnings ratio roughly equal to its annual earnings growth rate, Lynch suggested, was reasonably fairly priced. A stock trading at a price-to-earnings ratio meaningfully lower than its growth rate might represent a genuine bargain, still undervalued relative to how quickly its underlying profits were actually expanding. And a stock trading at a price-to-earnings ratio considerably higher than its growth rate was, by this same simple measure, looking overpriced regardless of how exciting or popular the underlying story currently seemed to the broader market. Picture two companies to see the logic play out concretely. The first trades at a price-to-earnings ratio of 15 and has been growing its earnings at roughly 15% a year, a PEG ratio right around 1, suggesting a fair, reasonably balanced price relative to its actual growth. The second trades at a considerably higher price-to-earnings ratio of 40, but has only been growing its earnings at around 10% a year, a PEG ratio well above 2, suggesting the market may be pricing in a level of future growth the company's own recent track record simply doesn't yet support. Lynch's method would flag that second company for considerably more skepticism and further investigation, even though its raw growth rate, taken entirely in isolation, still sounded perfectly respectable on its own. He was careful to note that the PEG ratio worked best as a quick, rough screening tool rather than a final standalone verdict on any individual stock. A company's growth rate could plausibly accelerate or decelerate going forward in ways its recent historical growth rate alone couldn't fully capture. And two companies with an identical PEG ratio might carry meaningfully different levels of genuine risk, depending on factors the ratio itself couldn't measure at all: the quality of management, the durability of a competitive advantage, or the overall health of the balance sheet. The tool was meant to sharpen an investor's initial instincts and flag stocks worth a closer look, not to replace the deeper, more qualitative homework Lynch insisted on throughout the rest of the book. He suggested pairing the PEG ratio with a specific related check that added meaningful context, comparing a stock's dividend yield alongside its growth rate for companies mature enough to pay one, since a stalwart or slow grower paying a healthy, reliable dividend could reasonably justify a slightly higher PEG ratio than a young fast grower paying no dividend at all, given that the dividend itself represented a tangible immediate return to shareholders that a purely growth-focused calculation would otherwise miss entirely. This adjustment mattered most for the more mature categories in his framework, where a meaningful share of an investor's total return was expected to come from steady income rather than purely from the stock's own price appreciation over time. This gave ordinary investors a rough, quick, back-of-the-envelope way of sanity checking a stock's price against its actual fundamentals without needing an advanced finance degree or an expensive research subscription to perform the calculation. Precisely the kind of practical, democratizing tool that ran through the entire spirit of the book. Once you own a stock, Lynch's framework doesn't simply end at the moment of purchase. He devoted considerable attention to what he called the ongoing portfolio checkup, a regular, disciplined habit of revisiting each individual holding category by category and asking whether the original story that justified the purchase still genuinely held true for a fast grower. This meant checking whether the earnings growth rate was still holding up at roughly the pace that originally justified the stock's valuation, and whether the company's expansion into new markets or new store locations was continuing on schedule, without signs of the overextension that so often derails an aggressively growing company. For a cyclical, it meant paying close attention to where the broader industry actually sat in its economic cycle, resisting the instinctive temptation to buy simply because the price looked cheap, or to sell simply because the price looked expensive without first understanding where that particular cycle genuinely stood. For a turnaround, it meant tracking the specific concrete evidence that the underlying business was actually improving as originally hoped, rather than simply hoping optimistically that a struggling company would somehow sort itself out eventually without any real verifiable evidence of genuine progress. He suggested applying a similarly tailored checkup to the remaining categories too. For a slow grower or a stalwart, the ongoing checkup centered mainly on confirming the dividend remained genuinely secure, and that the company's modest growth hadn't quietly slipped into outright decline. For an asset play, It meant periodically reassessing whether the underlying hidden asset, the timberland, the cash reserve, the overlooked subsidiary, had actually been recognized and reflected yet in the stock's price, or whether it remained just as overlooked as the day of the original purchase, a sign that either patience was still required or that the original thesis about eventual recognition simply wasn't playing out as expected. He noted a particular pitfall worth watching for, specifically with asset plays, one that distinguished them from every other category on his list: the risk that a genuinely valuable hidden asset never actually gets recognized or unlocked at all, regardless of how patient an investor remains. A company sitting on undervalued real estate or an overlooked subsidiary might simply continue sitting on that asset indefinitely, with no specific catalyst, a sale, a spin-off, a change in management, ever actually arriving to force the broader market to finally recognize the value everyone could see was there all along. Lynch encouraged investors in asset plays to think seriously before ever buying about what specific event might realistically trigger that eventual recognition, rather than simply hoping the market would spontaneously wake up to an obvious discrepancy that had, in some cases, persisted for years without any apparent resolution in sight. Lynch was refreshingly honest that even his own extensive research process didn't guarantee every single pick would work out. What separated a genuinely disciplined investor from an undisciplined one, in his view, wasn't a perfect record. Nobody achieved that, including him, but the ongoing willingness to keep checking each holding's original story against unfolding reality, and the humility to sell promptly and unemotionally once that original story had genuinely broken down, rather than stubbornly hoping for a recovery that the actual evidence no longer supported. There's a phrase Lynch used throughout the book that captures the underlying spirit of his entire method better than almost any single technical concept: the idea that the person who turns over the most rocks wins the game, not the person with the most sophisticated financial model, not the person with the most expensive data subscription, the person willing to actually go looking patiently and persistently in the ordinary places most other investors never think to check at all. He described his own working habits in terms that reinforced exactly this point. Years spent visiting companies, directly touring factories and retail locations in person, whenever possible calling company management with genuinely specific, pointed questions, rather than accepting a polished press release at face value and reading through the unglamorous fine print of annual reports that most casual investors skipped entirely. This wasn't a special genius unavailable to ordinary people. It was, by his own insistence, simply a habit of sustained curiosity and effort that any patient investor could adopt for themselves, on whatever smaller scale their own available time actually allowed. He offered specific, practical guidance on how to actually read an annual report worth the effort, rather than simply skimming the glossy opening letter from the chief executive. He suggested paying particular attention to the often overlooked footnotes and the balance sheet, sections most casual readers skipped entirely in favor of the more polished promotional narrative sections up front, precisely because those less glamorous pages tended to contain the specific details, debt levels, unusual accounting choices, pending legal matters that a company had less incentive to draw attention to. He also suggested comparing several consecutive years of the same report side by side, watching specifically for language that had quietly shifted, categories that had been renamed or reorganized, or explanations that had grown noticeably vaguer around a topic that had previously been described in specific concrete detail, often a subtle early signal that something worth investigating further was happening beneath the surface of an otherwise polished, reassuring document. He was equally blunt about a separate, entirely different skill required to actually benefit from all of this research once it was done: genuine emotional discipline, particularly during a market downturn. He observed that market corrections and even severe crashes were historically, a genuinely regular recurring feature of investing occurring with enough predictable frequency over any sufficiently long stretch of decades that an investor should plan for them calmly in advance, rather than being caught off guard and panicking each time one actually arrived. He lived through one of the most dramatic single-day crashes in modern market history while actively running Magellan in October of 1987, and he wrote candidly about the experience afterward. The fund, like nearly every other stock investment in the country, lost a substantial share of its value within the span of a single trading day. Lynch described resisting the overwhelming temptation to sell everything in a panic. Instead, relying on the same underlying conviction, his research process had always been designed to produce a genuine, well-grounded understanding of the individual companies he owned rather than a fragile confidence based purely on the stock price having gone up recently. The companies themselves, for the most part, hadn't suddenly become worse businesses overnight simply because the broader market had panicked. Their underlying earnings power, their competitive positions, their genuine long-term prospects remained largely intact, even while their stock prices had been swept up in a broad, indiscriminate wave of fear that had very little to do with any of those individual companies' actual circumstances. He described the specific, almost surreal texture of that particular day. Phones ringing constantly with anxious shareholders demanding to know what was happening, TV commentators speculating in increasingly dire terms about what the crash might mean for the broader economy, and a genuine, palpable sense in the air that something historic and frightening was unfolding in real time. What he found himself doing, rather than joining that panic, was pulling out his own research notes on individual holdings and reminding himself company by company why he had bought each one in the first place. Precisely the discipline his own story requirement was designed to provide in exactly this kind of moment. The stocks that had a genuine, well-researched story behind them, he found, were considerably easier to hold on to through that single terrifying day than any position bought purely on momentum or a hot tip would have been. His famous, oft-quoted observation on this point deserves repeating almost word for word, because it captures something essential about the entire book's underlying philosophy. He suggested that far more money has been lost by investors preparing for market corrections or trying to anticipate them than has actually been lost in the corrections themselves, meaning that the anxious defensive behavior triggered by the fear of a coming downturn very often does considerably more damage to an investor's long-term returns than the downturn itself ever actually would. If the investor had simply stayed calm, stayed invested in genuinely well-researched companies and ridden out the temporary turbulence, he offered a related, similarly memorable line elsewhere in the book, suggesting that nearly everyone possesses the raw intellectual capacity needed to make money in stocks, but that only a smaller number of people actually possess the emotional temperament, or, as he put it more colorfully, the stomach required to hold on through the inevitable, genuinely uncomfortable declines that come with owning stocks over any sufficiently long period of time. Brainpower, in his telling, was rarely the limiting factor separating a successful long-term investor from an unsuccessful one. Temperament was. He was similarly dismissive of investors, and even professional forecasters who spent enormous energy trying to predict where the broader stock market or the overall economy was headed over the next several months. Lynch argued, echoing a sentiment shared by more than one legendary investor before and after him, that this kind of macroeconomic forecasting had a genuinely poor track record even among the most credentialed professional economists, and that an ordinary investor's time and attention was almost always better spent researching individual companies deeply rather than attempting to divine the unknowable future direction of an entire national economy. He described attending professional investment conferences over the years and listening to distinguished economists confidently deliver detailed, precise-sounding predictions about interest rates, inflation, and the broader economy over the coming year. Predictions that, when he later checked back against what had actually happened, turned out wrong with a frequency that should have embarrassed the entire profession, yet somehow never seemed to diminish those same economists' confidence the following year. He drew a simple, practical conclusion from watching this pattern repeat itself for decades. An investor who built a strategy dependent on correctly predicting these unpredictable macroeconomic swings was building on a genuinely unstable foundation, no matter how sophisticated or confident the underlying forecast sounded at the time it was made. He extended this same skepticism toward a specific, commonly cited justification for avoiding stocks altogether during periods of economic uncertainty: the argument that an investor should simply wait on the sidelines until the picture becomes clearer before committing any new capital. Lynch pointed out, with some genuine exasperation, that the picture essentially never feels perfectly clear in the moment, no matter what point in economic history you happen to be standing at. There was always some fresh worry, some new uncertainty, some plausible reason a cautious observer could point to as grounds for waiting just a little longer before investing. Investors who consistently waited for that perfectly clear picture to materialize, he observed, tended to end up waiting indefinitely, missing out on years of genuine compounding in perfectly sound companies purely because the broader economic mood never happened to feel comfortable enough to satisfy their own understandable desire for certainty. His alternative was refreshingly humble in its own way. Rather than trying to predict where the entire economy was headed, he encouraged focusing on a much narrower, more answerable question: whether a specific, individually researched company was likely to keep growing its earnings over the coming years, regardless of whatever the broader economy happened to do in the meantime. A genuinely excellent, well-run company, he found, could often continue growing and rewarding shareholders even through periods when the broader economy or stock market as a whole was struggling, simply because its own individual competitive strengths mattered more to its specific outcome than the general economic weather everyone else was busy trying and mostly failing to forecast. This is, in a real sense, the quiet, democratic heart of the entire book. Lynch wasn't offering some secret formula reserved only for professionals with privileged access to information ordinary people could never obtain. He was arguing again and again in a dozen different ways across hundreds of pages that an ordinary person's everyday life, their shopping habits, their workplace, their children's enthusiasms, their own professional expertise in whatever field they happened to work in, already contained genuine valuable investment insight months or years ahead of when that same insight would eventually filter through to Wall Street's own analysts. He returned to this theme with a certain quiet insistence near the end of the book, almost as though anticipating that readers might otherwise dismiss the entire approach as too simple to genuinely work. He acknowledged that professional Wall Street analysts possessed real, genuine advantages of their own: faster access to certain kinds of data, direct lines to company executives, and considerably more time each day devoted purely to research. But he argued those advantages mattered far less than commonly assumed in the specific consumer-facing categories of company. His method focused on most heavily, precisely because an ordinary person's daily life gave them a kind of unfiltered real-time market research no professional analyst, however well-resourced, could easily replicate from behind a desk. There's a detail about Lynch's own life that adds a certain quiet weight to everything he wrote about patience, discipline, and knowing what genuinely matters, worth sitting with directly. At the height of his professional success, still managing Magellan, and still delivering some of the best returns in the entire history of mutual fund investing, Lynch chose to step away from the job entirely in 1990 at just 46 years old, explaining that he wanted to spend more time with his family after years of grueling 7-day work weeks spent visiting companies, reading annual reports, and managing an enormous, sprawling portfolio. He had, by his own account, missed a great deal of his daughters growing up while building that extraordinary track record, And once he'd achieved the kind of financial security that made stepping away possible, he simply chose to do exactly that, walking away from what was at the time arguably the most successful position in the entire mutual fund industry. It's a detail worth holding on to, specifically because it reinforces something easy to lose sight of, amid all the specific stock-picking mechanics laid out across the rest of the book. Lynch's entire method was built around patience, discipline, and a clear sense of what actually mattered enough to devote genuine time and attention toward. He applied that same clarity in the end to his own life and career, choosing to walk away from extraordinary professional success once he'd decided that something else, the ordinary, unglamorous, deeply valuable work of actually being present for his own family, mattered more. There's a quiet symmetry worth noticing between that personal decision and the investing philosophy running through the rest of the book. Just as he'd urged investors to recognize the genuine value hiding in ordinary overlooked places, a boring product, an unglamorous industry, a quiet Sunday afternoon spent noticing which store had a line out the door, he ultimately applied that same instinct to his own life, recognizing that the years spent at home with his own children represented a kind of value no amount of additional professional success could ever fully replace once those years had passed. The same discipline that helped him spot a 10-bagger years before Wall Street noticed also, in the end, helped him notice which parts of his own life deserved that same patient, undivided attention before it was too late to give it. The real work in his telling was never really about possessing some special genius for spotting opportunities. It was about paying attention to what was already right in front of you, and then having the discipline to actually follow up that observation with real research, a genuine understanding of the underlying business, and the patience to hold on once you'd found something genuinely worth holding. If you're wondering what any of this actually looks like translated into something you could genuinely start this week, Lynch's own method scales down to an ordinary individual investor more naturally than almost any other serious investing framework out there, precisely because it was designed from the outset with an ordinary individual investor's actual life in mind. Pay attention, for the next several days, to what you and your family are genuinely enthusiastic about buying, using, or returning to again and again, a product, a restaurant, a store, a service. When something stands out, don't stop at the observation itself. Find out which company makes or owns it. Pull up its recent earnings and check whether that growth you've personally noticed is actually showing up in its financial results yet, or whether the broader market has already caught on and priced it in. Walk through Lynch's checklist of qualities honestly and see how many the company genuinely satisfies. And if you decide to buy, write down in 2 or 3 plain sentences exactly why. The same simple story Lynch insisted every serious investor should be able to tell. Consider extending that same exercise to your own workplace and professional field, exactly as Lynch encouraged throughout the book. What are the specific products, suppliers, or competitors you and your colleagues discuss most often, the ones whose quality or reliability genuinely stands out from the rest? That specialized first-hand knowledge built up simply by doing your ordinary job well over the years may represent a more genuine, durable edge than anything you could discover purely by browsing financial news in the evening. Precisely the kind of overlooked advantage this entire book was written to help you finally notice and put to use. You likely won't find a 10-bagger on your very first attempt. Lynch himself, by his own admission, sifted through hundreds of ordinary, unremarkable ideas for every genuinely spectacular one that emerged. What matters isn't the first result. What matters is building the habit of actually looking, and of trusting that the ordinary details of your own daily life are worth taking seriously as a genuine source of insight, rather than dismissing them the moment the shopping trip or the family dinner is over. If any of this resonated with you, the full narration series continues on the Money Files audiobooks channel, where books exactly like this one get broken down in this same long-form, deep-dive style, perfect company for a long commute, a quiet workout, or simply falling asleep to something that might genuinely leave you looking at your own everyday life a little differently by morning. The next time you find yourself standing in a checkout line or watching your own kids get inexplicably excited about some new product or store, you might find yourself pausing for just a moment longer than you normally would. Not because every popular product hides a hidden ten-bagger waiting to be discovered, but because the habit of actually noticing the willingness to ask a simple, curious question about what's happening right in front of you is in Lynch's telling, where nearly every great investment idea he ever found actually began, not on a trading floor, not in a spreadsheet, but in the completely ordinary, completely unremarkable business of simply paying attention to daily life. Somewhere between the pantyhose in that grocery store checkout line and the largest mutual fund in the world sits a genuinely simple idea. One Lynch spent an entire career and an entire book trying to convince people to trust in themselves, that the answer, more often than anyone expects, was already sitting right there in front of them the whole time.